Hi, it's Lee, and welcome to the Tesla Economist. Okay, the stock price is really getting squeezed. We've had a massive sell-off, and now we're at $150. This could be Elon selling even more stock for Twitter. Although Elon is reassuring Tesla shareholders that they will benefit from Twitter in the long run, whether it means he will take Twitter public and reinvest those funds back into Tesla, or perhaps offer discounted advertising for Tesla through the platform, or some sort of way Tesla benefits through it, we don't know. And how far away is long term anyway? But Twitter has cost Tesla shareholders probably about $750 billion now. That would be a lot of advertising to compensate for the loss. The Twitter fiasco is something we have to cope with as shareholders. We look at the business as much as we can and study the fundamentals, demand, future of the industry, competition, supply chains, and everything. But it's hard to forecast black swan events, which is what Twitter is to Tesla. And we would hope that now we are at the peak of the hurt for Tesla, although some probably thought that when we dropped below 200 as well. Surely there comes a time when some big investors look at the stock price and start jumping in. Perhaps iconic investors like Warren Buffett or Carl Icahn might be tempted to invest, or maybe Apple might decide they want to share, as they can possibly influence Tesla with some sort of partnership when it comes to their electric cars, manufacturing, battery technology, or whatever it might be. Well, maybe. This is how I felt the first time I experienced Tesla drop over 50% from its high. The company valuation went below $30 billion, if I recall, at least around there. My thoughts were, okay, I'm down a lot on my investment, but there must be some floor as to the bottom before some sort of intrinsic value kicks in, or even the brand value alone, and Google or Apple start buying the company up. Then the stock price will recover to at least perhaps to where I was before. But it never happened. It recovered on its own as people started realizing, oh, Tesla's margins are that good because they broke through volume production, and despite only a run rate of under 100,000 a quarter, their margins look promising enough that if they ramp up to serious numbers like 1 million a year, then there could be some massive profits to come, despite only around 22% margins at the time. Then the stock price ran. But back then, during that downtime, it was rough. I would talk about it with my father every day, and we would wonder, why is the market reacting like this? What are we missing? Doubting ourselves until we bump into buts. But they have this margin. But they have this demand. But they have this low running cost. But they have this incredible performance. But they have such long range. But they have no competition. Why is the market reacting like this? Then all these people on CNBC shorting the stock, saying how it's going to go bankrupt. What did they know that we didn't? We were looking at the same numbers. One of us was saying the glass is half full, the other half empty. Well, right now I have plenty of rebuttals ready too. Right now, Tesla currently use perhaps 130 gigawatt hours a year of cells in their cars, or equivalent run rate as what they are doing this quarter. There is a new CATL factory being built with an estimated capacity of 80 gigawatt hours, supposedly for Tesla. There's a 10 gigawatt hour capacity of 4680s at Cato Road. There's a 100 gigawatt hour capacity of 4680 in Texas, and 50 gigawatt hour capacity in Berlin, or at least when the factories are complete and the lines are ramped up. That's potentially an additional 240 gigawatt hours of cells a year for Tesla. If Tesla are currently at 130 gigawatt hours, and we add 240 gigawatt hours, then that's a total of 370 gigawatt hours of cells available to Tesla. Yes, some of that is for energy, perhaps 40 gigawatt hours in the new Megapack factory, but either way, potentially we have 2.8 times as many cells available when all these lines are ramped up. So practically 3 times as many cells to come, except these are 4680 cells that are more energy dense and thus offer long range on a vehicle equivalent to a lot of the other cells when we factor in weight savings of the likes of structural battery packs and everything else. The 4680 also costs less, meaning more profit per kilowatt hour there too. In other words, the cells cost less and go into vehicles that are more valuable than, say, a standard range model. On top of that, CATL cells are likely going to be their N3P cells, which will be more efficient than LFP, meaning we get vehicles with longer range, yet the same cost per kilowatt hour, and could hopefully see a Model 3 with around 300 miles of range with these cells. What I'm saying is the future of these cells will have a higher profit per kilowatt hour. So although it's 3 times as many cells, these cells carry more profit per kilowatt hour. Not only that, they're for structural battery packs, the future of manufacturing EVs, which means the vehicles will be lighter, require fewer cells, get longer range, and of course cost less to produce. In addition to the lower cost cells initially, and like I said, they'll get more range, meaning they can be sold at a higher price point and incur more profit from lower costs and higher purchase price, meaning substantially more potential profit per cell. Rest assured, it doesn't stop there either. When we factor in economies of scale that come with this too, we could get into the details of how Tesla will be making Teslas in Berlin and thus save the cost in shipping from China, along with the tariffs due to all these economies of location. But the most exciting one is the operating margin, or what it really comes down to is the solid operating expenses number. That has actually come down over the last 3 quarters, if you believe it or not, implying despite we have 3 times as much battery supply, we wouldn't expect Tesla's operating expenses to increase much, which means basically all this additional gross profit goes straight into operating profit. And it also means that instead of seeing 30% gross margins, we could end up seeing 40% gross margins for the majority of this additional production, which means we go from a 17% operating margin to one perhaps closer to 30%, almost double the operating margin, with almost triple the sales. So perhaps around 5 times as much total profit, which would take us to around $100 billion annual profit. Highly possible without even building any more factories than Tesla currently have, assuming a large revamp for a new manufacturing process for the Model 3 Highland at Shanghai and Fremont. It can be a lot harder to focus on the company in these terms when there's so much noise right now and being amplified to make it louder than it is organically. It's hard to establish much of the credibility of the noise, but we do know it makes for good headlines for clickbait. Short-term investing is like a popularity contest. Even Rivian was super popular through a brief period. Some people say Tesla will never return to its highs, but I genuinely think Rivian will never return to its high. It was worth over $100 billion. Fortunately for Rivian, they had such a good IPO, they now have a ton of capital to last them to potentially make a profit. Unfortunately for them, is they're still getting through that capital at a rapid rate. Tesla was worth over $1 trillion. Will it ever get back there again? Well, I've just shown you a path on how they can get to a profit of $100 billion a year based just on what factories and lines are in place now, or at least when CATL's factory is complete next year. And phase 1 of that should be open in Q1 2023. It's possible Tesla could have all these lines ramped up by the end of next year, or earlier. They intended on having Texas at this rate already. We were spoiled for a while with Tesla. It took off something crazy, and we didn't think it was going to stop. We need to get real a bit more and look at this as an investment, not a get-rich-quick scheme anymore. It's going to take time, and the PE ratio will reflect that more and adjust accordingly. However, if Tesla are at a rate equivalent to $100 billion a year when these lines are all ramped up, I would think that we are at an all-new time high, and Tesla may get back into the popularity contest again. The thing is, we would also expect the cell production to grow exponentially. Tesla is still trying to figure out the engineering behind the 4680 cells. Once this is worked out, then wouldn't we expect Tesla to simply, for lack of a better word, rinse and repeat? Just like how Tesla are doing such an outstanding job in manufacturing in Shanghai, and now bringing over hundreds of the engineers from that team there to help in Fremont and other factories too. The country is designed around it, and thus has so many more people who have specialized in various facets of manufacturing, specialists you simply can't get in other nations. I'm really happy to hear that Tesla are bringing over these specialists to do what they can. Might I remind you, the Model Y Shanghai factory is now at 4 times capacity from what we were initially told. Elon has said he thinks Fremont could hit over 1 million units before. I'm sure it could. Then if Shanghai Model Y is at this rate, what will Texas be able to achieve with front and rear castings along with a structural battery pack? The manufacturing architecture is simply better in that factory. It will take some time to ramp up, and hopefully things will move much faster there once they've sorted out what needs to be sorted. Anyway, it is tough right now, but it's really stemming from the fact that the largest shareholder is selling a large amount of his shares, and supply and demand is also a thing when it comes to the stock market. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.